Hi, everyone. My name is Sarah Regala, and I wanted to welcome you all to the City Different Investments Q3 webinar. Thanks for being here today. I'd like to get started with a sort of macro look at the market. So I'm going to go to Chris Ryan first with our fixed income team. Given yesterday's news conference with Chairman Powell and the current global unrest, why do you feel like the markets are so strong?
Well, that's a relative comment. If we go back and look at where we were in the beginning of June on the 10-year Treasury, we were about a 384. We topped out at 492, and right now, after all said and done, we're at a 467. So it's still rates have been moving higher. One of the real interesting things is the inversion in the yield curve has lessened dramatically. At the end of June, the 2-10 spread, which is a measure of the inversion, went from minus 1.1% to right now around minus 0.25%. So as we think about it, we are moving from a period where we had a new normal, with the pandemic, zero interest rates on the short end, a Fed buying bonds, to more of an old normal. The Fed funds rate is now about 5.25%. If you listen to the talking heads on television, their hair's on fire going, the rate's up 500 basis points. Well, the long-term average of the Fed funds rate is 5.25%. So, we have to recognize that what we went through during the pandemic was the anomaly, not the normal situation. And it has some ramifications for what's going on in the market today. The economy has proven to be very resilient. And why is that? One of the major reasons is that sensitivity to short-term interest rates is much less in this period than it has been in the past. And that's because corporations and homeowners took the opportunity of that zero interest rate environment to refinance their mortgages and to extend their debt. So they're not as dependent on short-term rates. In terms of the mortgage market right now, the average coupon on a home mortgage is about 3%. If you replace that right now, you'll be charged about 8%. So that has caused the housing market to be completely screwed up. In the third quarter, we had GDP levels at 4.9%, well above expectations. We have unemployment about 3.8%. The economy seems to be doing quite well. There are 1.5 jobs available for everyone looking for a job at this point in time. Now, we're going to get the employment number tomorrow. That may change things on the dime, but I doubt it. I don't think we're going to have a Miskey moment. But even yesterday, when the Fed, in the news conference, the market seemed to take everything Chairman Powell said as the rate rise is over. We didn't hear that. We heard that we're just going to watch and see what's going on in the market, that the rise in rates, the steepening in the yield curve is helping us in our desire to cool down the economy and bring inflation down. I don't know I did not hear that in his comments. I heard more of the same. So markets have a tendency to overreact. We might have seen that. We'll see what happens tomorrow. And with that, as we're starting off with fixed income, I'd like to turn everything over to my partner, Shweta Singh, to talk about how our fixed income performance was during the last quarter and year to date.
Thanks, Chris. For my part, I will focus on performance for the fixed income markets, and my remarks will be broken into tax-exempt and taxable market, i.e. investment-grade bond market. So let's start with the municipal bond market for the third quarter of 2023. AAA general obligation bond yields in the municipal bond market increased anywhere between 72 basis points to 89 basis points, dependent on the maturity. And Chris alluded to the Treasury yield curve in terms of the slope of the curve and the inversion. The same theme translated in the municipal bond market as well. The 1 to 10-year yield spread, or the inversion, began in Q3 at negative 46 basis point, and towards the end of the quarter ended at negative 29 basis points. The theme here is that the inversion is reversing. In terms of the municipal bond market and the treasury bond market, municipals did see some underperformance in relation to treasury, but the takeaway here is that the muni richness came in a little bit. As an illustration, 1-year munis that started the quarter at 55% treasury to muni ratios went up to 68%. That's the biggest delta increase happened in the shorter part of the curve where munis became more attractive. The 5-year part of the curve, munis started at 62% of treasuries and went up to 73% of treasuries. You saw the same theme in 10-year part of the market from 66 to 75% treasury muni ratio. The Bloomberg Municipal Bond Index was down negative 3.95% for the quarter and negative 1.38% for year to date being September 30th, 2023. Now diving into City Difference municipal SMAs and their performance vis-a-vis the benchmark. For short-term CDI SMA, we ended the quarter at negative 70 basis points versus the benchmark index, which is the 1 to 5-year index, at negative 1.18%, the difference being a positive 48 basis points in favor of CDI SMA. In terms of limited term CDI SMA, we ended the quarter at negative 1.67% vis-a-vis our benchmark index, which is 1 to 10 year, at negative 2.23%. Again, 56 basis point of outperformance in favor of CDI SMA. Finally, with regards to our intermediate term SMA, we ended the quarter at negative 2.34% versus the benchmark, which is the 3 to 15-year custom blend, at negative 3.14%, yielding a 79 basis point positive difference for the intermediate term CDI SMA. Performance mostly came from investment decision of staying short and close to neutral in terms of duration for our respective strategies. Now moving on to our taxable bond market. As Chris referred to, treasury yields did increase in Q3, anywhere between 88 basis points to 5 basis points, depending on the term of the treasury. In terms of Bloomberg Ag, the quarter ended with negative 3.23% for the quarter and negative 1.21% year to date. In terms of taxable limited term CDI, separately managed account, we ended our Q3 at negative 62 basis point vis-a-vis our Gov Credit Index for 1 to 10 year at negative 83 bips, yielding a 21 basis point of positive difference in favor of taxable limited term CDI. Much like our tax-exempt SMA, performance came to these strategies by being duration neutral. Before we hand off to our equity counterpart, there is a marked difference in terms of our Q4 investment decision for the fixed income team, which is we are working on getting to the top end of neutral with regards to all of our strategies. This stems from our belief that we are on the tail end of Fed rate hikes. That's it from the fixed income team.
Thank you so much, Krish and Shweta. So now let's hear from our domestic equity team. I know, Connor, we have been working on a piece to be released early next week about your local endowment committees that you and both Chris Ryan are on. Do you want to share a little bit about that and why it might be relevant to listeners?
Yeah, sure. I just think it's helpful occasionally to take a step back, take a really long-term view. Chris and I both serve on a handful of endowment committees locally, and nothing like an endowment to get you thinking about the very longest time horizons when it comes to investing. But in this piece, we were just going over sort of thinking through allocations and where we are, and maybe some highlights, little exclusive sneak peek here for our audience. a bunch of data as of end of September 30. So I think we all know that the Magnificent Seven is driving a lot of the stock price change in the S&P 500. It's driving a lot of valuation, almost in global markets in a way, except for during the internet bubble. Value remains really cheap relative to growth at almost historic levels over the last 25 years. Now, we never recommend going all in on one bet on value, but it does remain. It seems like it remains to us a good time to keep tilted a little towards value versus growth in the U.S., especially. Small stocks remain very low in average valuation relative to larger stocks. By the way, on that large value versus large growth PEs, large value about a 14 PE at the moment in the US versus about a 14 PE on average over the last 20, 25 years. Large growth 24 PE versus a 19 PE average. So small and mid, really low valuations relative to the S&P and then relative to the Magnificent Seven. You do need to be careful. More of the Russell 2000 is unprofitable today than it's been in almost 25 years. So nearly half of the companies in the Russell 2000 are not profitable versus as low as 20% or so at the beginning of the millennium. So you got to be careful in that small and mid cap world, but there does seem to be some valuation opportunity there. And then finally, looking at international versus US, we are 2 standard deviations out in terms of valuation difference. ACWI US is actually at a discount on a PE to its long-term average today, 12.5 versus 13 long-term average, while the S&P 500, despite much higher interest rates, which should drive valuation in equities down somewhat, remains at a 3 or a 4 multiple turn premium to its long-term average. So by and large, small and mid cap seem interesting. Value seems interesting to us, and moving outside the US seems interesting. We'll hear more on that from Vin later. But Rob, I wonder if you might touch on where we're finding opportunities, especially in the small and mid cap space in the US.
Yeah, thanks, Connor. I think the interest rates are a very interesting story. We've had the recent rate rise. Prior to that, in the low interest rate environment, it was easy for a lot of untested businesses to get funding. And similarly, public market investors would give high multiples, high likelihood of success for unproven businesses that may be disruptive, may be new and change the world. But that sometimes happens. It's a rare event. And I think the market was pricing in at all of these businesses being successful. With the rate rise, I think investors are in the process of moving back to business fundamentals. Is this a proven business model? Does it have barriers to entry? Is there free cash flow? And so that's interesting to us. I think it's when we think about businesses, that's what we're looking at, and I think that's hopefully where the market's going. And so, as Connor mentioned, the small caps have sold off, and you think of rising rates. That means higher interest expense for especially for smaller companies. So with that sell-off, but there's lots of areas to uncover good ideas that will have funding that are profitable. So I think there's lots of opportunity out there. And then one specific area I think is kind of fun is the weight loss drugs. So this is GLP-1s, and so which I think will be a huge. I think it'll probably change the world. Just the impact that these will have. But just as the market likes overreact, or it's hard to know what will be impacted. and so the market's taking guesses of what it is. A lot of people say that the GLP-1s are the AI of healthcare. So it's sort of like there's tons of hype around it. We don't know. We'll see. There'll be impacts. They're hard to know exactly what they are. But healthcare is a good spot to look for ideas.
Definitely. Super interesting. Well, thank you both, Connor and Rob. Now I want to go over to our global team. Vin, we spoke a little bit earlier about sort of global unrest. What are you seeing in the global markets?
Well, it's been a very dynamic and I'd say engaging period in the markets this year that we've this last several quarters now. Quite interesting as an investor and as an analyst, and as it often is. With overall quite positive results, as everyone knows. For our global strategies, we've been very fortunate recently, and I think I said last quarter we had happy clients, and now we have maybe happier clients. So we've been happy to deliver that result. Great to see with the third quarter result, as you can see on our website, up about 10% for our global strategies in a down market. So that's what we work towards. The themes there, it's been broad-based contributions across the portfolio, but a couple of things that stand out. One is the international, our non-US stocks have been big standouts in the third quarter. Our top contributor was a Canadian nuclear energy related company, and number two was in Norway. So we're taking advantage of our global mandate, and the non-US standouts were great to see recently. As far as industry themes, it's pretty. We have several different things going on in the portfolio, but what you notice for sure is our nuclear energy thesis continues to play out nicely. We wrote about that about a year ago, and that's been a lot of confirming data, and actually more even better results than we would have expected as far as how the fundamental developments are playing out in nuclear. We may have an update for our investors in more detail, maybe at the end of the year on that. And another thing that stands out is e-commerce. No secret that e-commerce still presents strong secular tailwinds. We think opportunities for investors. The challenge is finding the winners and the underappreciated models, because there's an awful lot of companies and they're not all winners. But we've been real happy with our contributions there in e-commerce, and keep sticking with both of those things and both of those themes, nuclear and e-commerce, from here. As far as the outlook goes, like usual, we don't have a precise outlook or forecast. We do take it from a bottom up kind of perspective. But I would say again, we've had more than a year's worth of great results here in the last few quarters, and so it's worth just enjoying that, but also taking a deep breath and recognizing we're above trend as far as the actual results lately, and I think it's worthwhile resetting your expectations for the long term and at more moderate levels going forward. I also noticed heard Connor commenting about the Russell 2000 and maybe the risks in the smaller company land, and I would echo that quite loudly. As we do our bottom-up research, we notice, a lot of a kind way to put it would be a lot of unproven business models still in that category. And my guess would be there'll still be some sorting out and disparate outcomes there, including a lot of things that we are intentionally avoiding in this smaller company and consumer space. What I've noticed, whether it's restaurants or retailers or exercise equipment, seems like there's still quite a bit of speculative froth in that category. But we're not investing there. We're investing in course, what we think are durable long-term trends. Real happy with the results so far, and steady as she goes. Constructive on the long-term outlook.
Great, thank you. John, I know you just returned from a trip to China and Singapore. I was wondering if you had anything to share from your travels and what you're seeing over there.
Yeah, sure. So for those who don't know, I actually spent the last 6 months working remotely from China, and it was quite an experience. And I gotta say kudos to my bosses for making it possible. So, and in terms of being in China, I think contrary to what you read in the newspapers, I don't think the Chinese economy is collapsing tomorrow. It's still a very, very vibrant economy, and from the ground, things does look weak, but I could see consumers splurging in certain areas like education, travel, eating out, EVs, stuff like that. So there are pockets of strength in the economy, and me and Vin are digging into areas that could potentially turn into investment ideas for our global strategies. And I was also in Singapore for 10 days, and that's where kind of Golar had its latest FLNG tanker, Gimme build, and it just left the shipyard actually just a couple of weeks ago. So just kind of want to bring it up. It's still an exciting investment for us, and we wrote a recent blog post. So just want to make a little advertisement for what we wrote about it, and hope you read it. But yeah, I'll turn it back to Sarah.
Well, I love when you promote the blogs, so I appreciate that. That's great. Well, now I want to give anyone who is on the call a chance to ask questions. I've had one come in so far, and please feel free to put them in the chat if you have a question for any of our portfolio managers here. But I've got one for you guys, Chris and Shweta. What is your current view on bond value?
We think that this is a great environment for prudent risk-taking in the bond market, whether it be taxable or municipal. As Shweta mentioned, we're moving our durations up to the top end of neutral. And the main reason for that is investors are finally able to beat inflation with the yield on their securities. A measure known as real yield, which is the yield on the security less an inflation measure using core PCE, you're now finding that you have real yields, positive real yields, 10 years and in. The most increase in real yields, the most value is in the 1 to 5 year range. As I mentioned, the 2-10 spread went from minus 110 to minus 25. Long-term average is plus 100. So we think taking prudent risk, keeping your maturity short, waiting for the curve to steepen is will add a lot of value to an investor's portfolio. We also think that credit spreads are still very narrow, so there's no reason to go down in terms of credit quality. Shweta, would you like to jump on that theme?
Yeah, I'd echo almost all of what you said, Chris. And I have empathy for investors being gun shy coming out of the last 2 years in the fixed income market. But if you believe that the Fed is on its last leg with rate hikes, which we do believe here at City Different, this is a great time to dip your toe into the water, into the fixed income water, and look into the investment grade fixed income universe. Like Chris mentioned, we don't think that high yield markets exhibit the spread value that we would like to see. However, the fixed income high or investment grade markets are finally showing positive real yields and are actually producing income after a long time.
One thing I'd like to add is that investors should really be worried about the cash trap. Okay, investors have done extremely well in money market funds, and they've been a great investment over the last couple of years, but they have an average maturity of anywhere between 20 and 30 days. That means if short-term rates start to come down, the yields on those money market funds are going to drop like a rock. And if an investor takes on a little bit extra duration risk, moving out to a 1 to 3 year laddered portfolio and combining that with a a portion of their assets in a money market fund, they will create a more durable and stable dividend into the future.
Great. Well, we said that it was going to be 30 minutes. We're right at that mark. So I'll go ahead and wrap it up unless anyone has any other questions. But thank you all for being here and for sharing your insights. For more great information from this team, please subscribe to our blog and our week in review so that you can get the stuff delivered directly to your inbox. Thank you all.